So welcome everybody to this new episode of the Panelfit monthly chat. Today we have Gert Meyers, from a researcher at at Tilburg University and KU Leuven. So welcome, Gert.
Hello.
Hello. So first of all, I'd ask you to briefly introduce yourself.
Yeah, so I'm Gert. I did my PhD in Leuven, where I studied how the insurance industry is using big data to personalize insurance products. And I focused on what I call behavior-based personalization. And I'm particularly interested in how these new data practices affect the mechanisms of solidarity, because we know insurance as an industry of solidarity and a mechanism of solidarity, and also on how these new types of products or experiments reconfigure the roles and responsibilities of insurers and insureds. And now, since November, I work at Tilburg University, where I'm involved in a project on how governments are using blockchain technologies, and how this affects trust in government, and how this affects value conflicts or values in the rule of law.
Okay, thank you. So let's start with a very general question. Uh, uh, what is the magnitude of the insurance field in Europe?
Yeah, the field of insurance could be expressed, I think, as a value, as a monetary value, but that doesn't say much. For instance, I think there were in 2018, according to Insurance Europe, over 1.2 trillion euros of premiums paid. So that's the price people and companies and governments pay for insurance products. And that doesn't say much because it's ridiculously much. It's I think the GDP of Spain or something that is fully going to insurance only in Europe. But it does say something when we think of where insurance is in our lives. The house we are sitting in now is probably insured against fire. The car we drive or people drive to work or to whatever is insured against the damage you cause to others. Pensions are in a way an insurance against living longer than expected. And health insurance doesn't protect you against becoming sick, but it helps you at least to not worry about the costs for hospital bills. So in a way, insurance is everywhere in our lives. And insurance is not just a market or a sector or an industry in society. We can say that we live in an insurance society where society would not really function as it is now without this institution of insurance. For instance, think of economic risk that is being taken or entrepreneurial risk that would not be taken without being backed by insurance coverage. And also think of the public insurance mechanisms that we have, such as universal healthcare access, pension schemes, and so on, which protect societies against macroeconomic shocks, or at least better than a situation where there is no such thing as a universal health care access. So we could ask ourselves what would have happened to European societies when there were no such mechanisms, such as um, benefits for falling out of a job, with the corona pandemic we are experiencing nowadays. And sometimes insurance is a market, but it is always much more than that because it is attached to these values of solidarity and these practices of solidarity. And sometimes insurance is part of public policy, but it is always backed by financial models and risk assessments and so on. So that makes it so interesting because it's everywhere, and at best it is very invisible because we all hope not to have to be being bothered with insurance products, because that means that something went wrong often, that you broke your leg, that you crashed your car. Um, and one example is maybe the pension, because the longer you can use a pension, the longer you live, and that's maybe a positive use of insurance benefits.
Yeah, it's very interesting, and I guess when we talk about insurance, often we focus on the market aspect of the thing, but it was very interesting to underline also the other aspect you mentioned. And so, yeah, focusing on the topic of this chat, which is the use of big data analytics and AI in the context of personalized insurance. I'd start asking you what types of data sources can be used in this context.
Yeah, data have always been used by the insurance industry. I often say that insurance is a big data industry since the 19th century, when they started to use what they call printed numbers and when statistics came up. But of course, big data brought a whole lot of new types of data, and but um, there are different types of data that are used, but not all data that could possibly be interesting can be used. Yeah, first of all, there are often practical limitations to data collection. The first that make that it's not interesting for insurers to collect all the data they could, because it would be too costly. Secondly, there are some requirements that the data used should comply to. For instance, um, the data used have to be what are called objective. So they have to refer to actuarial models where they really show that these data collected have a connection to the risk that is insured. And if that's the case, these data can be used to differentiate prices between different types of policyholders. Um, but there's another important further restriction to these data uses. That is that they also have to abide to anti-discrimination legislation. For instance, it's not allowed to use genetic information in insurance contracts. That's because of the Genetic Non-Discrimination Act. Um, and that is because we cannot control what type of genetic information we have, which would make you would be punished if you are um, unlucky enough to have bad genes. And the same logic goes with gender, which is forbidden since 2012 to use, for instance, in life insurance, and also in car insurance, which is very funny in a way, because it was um, claimed by feminist organizations that it is not fair that people are differentiated on their gender, but um, women are, as a group, much safer drivers. They make much less damage, but now they have to pay more because they cannot be differentiated. But that's perfectly fair in my view. Um, and these restrictions make that not all data can be used, but a lot of data are used. For instance, when you buy a car insurance, it's very relevant what type of car you are driving, because the horsepower of your car is a good predictor of the expected damage or the expected car accidents you will be involved in. Your age is kind of relevant when you are buying a life insurance. Um, and there are discussions on the use of age information and whether or not this would be age discrimination, but this discussion is still on. Also, when you're buying a life insurance, your smoker status is used to attribute a risk to you. When you're a smoker, you have a higher chance of getting lung cancer. Therefore, this is used to differentiate between premiums.
Yeah, so it's as we see, a very broad topic,
Yeah,
and it raises also some issues. The one you mentioned about gender equality, the price of gender equality is very interesting. And yeah, you were
yeah,
saying something.
yeah. But then again, it's what the restrictions I just mentioned are mainly in the pricing of an insurance product. So in setting the premiums and setting different premiums for different types of people. But there are also some ways around this, because at many points in what insurers then call the life cycle of an insurance product, data can be used. Well, these data I just summed up, like gender and genetics and so on, cannot be used to price a risk, but it is perfectly imaginable that they will market and advertise insurance products to a certain type of people or certain group of people. For instance, when they use Facebook ads to target to women drivers because they are more safe. There's also a UK insurance product called Drive Like a Girl, who is having a perfectly pink website, as really marketing towards women, and says we but cannot bluntly deny access to insurance to men, but they market it as a very womanly product. And one of their taglines is that everyone is perfectly welcome to this insurance product as long as they drive like a girl. So they do not have to be a woman or do not have to be a girl, but they are expecting their policyholders to drive like a girl, which means safer.
Yeah, this is interesting because it seems to push a stereotype by denying the common stereotypes. I don't know, at least in Italy, there is this stereotype about women driving. So it's interesting, there's two
Yeah,
different, two contrasting trends. So you briefly mentioned the issue of costing and pricing. So I'd go with the next question, which is about the difference between costing and pricing and why this matters in when it comes to using big data analytics in insurance personalization.
yeah. In all market situations or contracts where you have a service or a good that has to be sold to a client, you have certain costs and the price for a product that might not be the same. In some markets, there's a very loose relation to the cost and the price. Um, in other markets, like in insurance, there's quite a knot between these concepts. When you say that the cost of an insurance product is the expected number of claims that you have to make within this insurance product, then this has to be estimated with statistical models. Um, and the idea of costing can be called then the assessing of the expected cost of a certain type of insured person. And of course, big data analytics can be used to make this model more fine-grained and to enable much more specific assessments of these expected costs. Now, for pricing, it is you could expect that the price of an insurance product should always be a bit higher than the cost, because otherwise um, insurers would go bankrupt if they have to pay out much more than they are asking from their policyholders. But at the same time, it cannot be very much higher than the cost, because then insurers fear adverse selection. That means that people who expect from themselves that they are healthier or safer or less risky than the cost of an insurance product reflects would choose not to buy an insurance product because it's too expensive. And then there are all sorts of consequences, but there needs to be a tight relation between the costs and the price of an insurance product. With big data analytics, it's sometimes expected that the because through big data, the preferences of customers can be known much more fine-grained. They might find out people that are very risk averse and are, um, let's say, willing to be insured against any price, that they will be charged higher prices. Um, Whereas this is not the case with people who are less risk averse and will only accept the price for an insurance product very tightly to the expected costs. But then again, this is not really possible at the time, I think, for qua differentiation, because as I said earlier, they have to prove when they are going to differentiate prices that there are objective reasons to differentiate these prices, and that means that a group of individuals as a group has a higher risk and so is having higher expected costs. So in this way, there might be some fears on big data for the much more fine-grained pricing. But this has always to be backed by the regulatory requirements, which says that there need to be objective differences.
Okay, and I'll change a little bit the order of the questions to
Okay.
to go a bit on practical examples.
Yeah.
So if you can give us some examples of how can big data analytics and AI be used in the context of insurance personalization.
Yeah. I did myself some research into personalization and car insurance based on the behavior of people and behavior personalization based on the behavior of people and mainly drivers. And there we see that there are mainly, at least in Belgium and the Netherlands, some experiments made with what's called usage-based insurance, um, and that these insurance products do not provide what is called individualization, so to say, and that is making ever more smaller and smaller risk segments until you have what people call the segment of one, and that is that what cannot be longer be divided, it's indivisible. So an individuum. What we see is kind of personalization, where people are clustered into types of persons. For instance, often referred to type of person is the soccer mom. So it's the car driver that brings the kids to school, then has to fulfill all these kinds of household tasks, then gets them from school and do all the sports activities of the kids and so on. So it's a very busy type of short distances driven and so on. But these types of personalization and these grouping of people into types of person is quite broad at the moment still. Often it's they work with color systems, like you have green drivers, orange drivers, and red drivers, or maybe one more cluster of people. So it's very basic still. But what we see with these types of personalization is that there is a shift of responsibilities, both by the insured people, so the policyholders, because they get responsible for their own driving behavior. They are, on the basis of this, grouped into being a type of driver, but this is not a final judgment, so to say. People can improve or worsen their drive style, so they can change, it is said, and they get some tips and tricks by the insurer often. And there we see that there is a new responsibility also for the insurance company, because they are having the new responsibility of pushing their customers to do better. So there's also a new responsibility. What we see with these types of grouping of insureds into types of persons or types of drivers is that we also see all sorts of new forms of pooling and redistribution. Whereas earlier on, it's at the moment you buy an insurance product that you are grouped into a risk group and that you are risky. It's something it's hard to escape these types of groups. And then within these groups and also between groups, but mainly within these groups, you have redistribution and solidarity, because when someone like you is having an accident, the pool of people is going to pay for your accident and the costs. Now, when you have behavior-based personalization, there are also often some benefits to being a good driver. Often they are not expressed as money, but as benefits. Then there is not a redistribution finding place that is based on having an accident or not having an accident. So the risk against you were insured that kind of gets alive, but mainly about how risky you are. And that is something you can change. But then again, you have a new type of redistribution based on behavior. And that also, as I said, comes with all types of new forms of responsibility.
Yeah, that's interesting. Because we always name it like personalized insurance, but maybe it's more a mix of segmentation and personalization. It's not that precise as we figure it, or maybe I don't know. Maybe insurance companies need to claim that there is this very precise personalization to induce good behaviors in customers. I don't know. It's a guess, but from your description, could be, I don't know. Seems to make sense.
Yeah, and of course, in making these types of persons and this personalization, there are some data that are collected all the time. That maybe I forgot, or I should come to it. These data, they are collected from sensors that we have all carrying with us, and mainly these are the smartphone sensors. So in car insurance, these can be calibrated to guess how hard you are accelerating or braking, how hard you are cornering, but also what if you are what they call legal driving, and that is whether you are driving too fast or too slow. So then therefore they need some GPS location and so on. With health insurance, they also can, for instance, track how many steps you take, what is your heart rate, so your pulse and so on. But the difficulty with health insurance is that it's very hard to know what is a good lifestyle. We all think that 10,000 steps a day is a good amount of steps taken, but that's not at all obvious. It's also very hard to say prove that 10,000 is good, less is not good, more may also be not that good, but also how to differentiate between 10,000 and 8,000, or between 11,731 and 11,300, so to say. So how to make these fine-grained differences reflect in the risk for getting sick, dying early, and so on, that's very hard to make.
Yeah, and also, I mean, I can take a walk and not bring my smartphone, so all those steps will be lost. I mean, I can't be forced to have a device with me to prove that I am a healthy person. I mean, I could give my device to a healthy person, and I don't know.
You think that there's all
hijack
sorts of,
the system.
there's also sorts of what they call tracker hacking,
Mm-hmm.
and that is that you, for instance, give your smartphone to your dog, but
Yeah.
then again, I heard of some experiments where they kind of are able to identify who is walking, for instance, by the length of your pass.
Yeah.
So that you also would have you also would need a body that is exactly the same height as you and has the same pace and so on. So that's also could get harder, but there are all sorts of hacking, as you know, as you uh,
Mhm.
perfectly pointed out.
Yeah, I guess that if you stop at every tree you stumble upon, maybe it's maybe it's your dog.
Yeah.
And yeah, it's very interesting. I'm afraid we're running a bit late,
Okay.
so I will ask if there are questions. It's time to ask them. As I wrote in the chat, you can type them in the chat, in the text chat, or raise your hand, and we will give you the word. Otherwise, we can ask maybe the last question to Gert. Okay, let's move on. If someone wants
Yeah,
to
please.
ask something, feel free. I was thinking about the we talked about more or less the implications of this system, or maybe we can say something more about the ethical implications, which are, I guess, more general. They're not specific of this field, maybe, but I guess there is something specific of this field. And the last one question is related to the last answer you gave. I'd like to know if this data collection comes by a specific app that customers are asked to install in their devices, or you simply give insurance companies access to some statistics from your device. And the very last question is about does it work? All this data collection and processing leads actually to more precise costing evaluation and maybe pricing decisions.
Yeah. So first of all, your question about do you need to install an app by an insurer or not? Often when you see these experiments, it's linked to an app indeed by the insurer, where you give consent to use this information for these purposes. So I assume this is perfectly legal. It's not that the insurer is going to buy your data from a broker or something. I don't think that's the case. Also, in this app, there's will be a small device that activates the sensors that are already present in your phone. So in this way, they can collect these data. And as I said earlier, for now, I do not think that they are already using these data for actual pricing practices, but mainly for developing models to do so. And that relates to your last question about do these data analytics are actually going to be more precise and accurate. And that's hard for me to say because I'm not a technical expert. But what we see, however, is that these types of AI and other types of new data analysis tools, they do not always abide to the rules of statistics because, of course, it's probabilistic and so on. But they do not start from a hypothesis. They do not. They are not able to be really fixed into some grid. And when you talk about machine learning or deep learning and all these things, so it's very hard to know how a certain type of classification is made. And this gives some problems for explainability. And this explainability is important, especially in insurance sector, because they have to explain why they differentiate and why certain types of differentiations are objective. And so for the legitimization of these models, it's very important to be able to explain these data. And also when we look at other sectors where types of personalization are taking place, for instance, in marketing, so on and so on. There you see also that there is price personalization, but it is very hard to know which group you are part of, and that might have some consequences for the support for the solidarity that is present in insurance. So it's very easy to know that I am a relatively young guy with a job, an okay health, and I can identify with other people that are roughly like me, that are similar in relevant aspects, so that you can imagine being part of a risk pool, and are you also willing to pay for the bad luck of people who are part of your risk pool. But when being part of a risk cluster, so to say, when you use the terminology of AI and so on, these clusters, they are so dispersed, you do not know why. Is it because I have a smartphone of a certain type that my favorite color is blue and my bike is green? I don't know. But when these types of characteristics make you are part of a group, it's much harder to feel and part of this group and see yourself as part of a group with whom you have some risks in common. So this might be a very tricky thing for insurers um, to generate and to have support for solidarity that is taking place anyhow. Because as long as there is insurance, there will be solidarity.
Okay, thank you very much, Gert. It was a very interesting conversation. Yeah, I hope you keep us updated about your research, because I see many interesting starting points for investigations and also journalistic stories, let's say. So again, thank you very much, Gert.
You're welcome.
And thank you to the audience who was with us. We'll see in 2 weeks with another chat. So have a nice day.